Wall Street widely expects the central bank to raise its benchmark interest rate, but investors will also be on the lookout for any clues into the Fed's outlook for the remainder of the year. And although the U.S. economy appears strong, my next guest says investors, they need to exercise some caution before jumping headfirst into the financial markets. Joining me right now is legendary investor and Janus Capital Portfolio Manager Bill Gross. Bill, good to have you here. Good to see you.
Hey.
So we get the market.
Thank you, Trish. Good to be here.
It keeps moving up, but this is getting you worried right now. You're worried about these valuation levels. Tell us why.
Well, I am. I think all markets, all asset markets, whether it's low bond yields and high bond prices or high stock prices and high PE ratios, are all being influenced by artificial money coming from central banks. For the last 4 years, Trish, central banks have put into the markets $8 trillion worth of money through their quantitative easing policies, and they've kept interest rates close to zero. And so there's no doubt that prices are artificial. The only question is, will it lead to real economic growth? And if not, when does the musical chairs game end?
I hear you on this, but yet at the same time, you've got a Fed that has backed off some of that aggressive money printing. And they're in an interest rate rising environment right now, Bill. So are you telling me that the hangover effect is still there enough to cause you real concern? Hangover, I mean, from all the money printing.
I mean, the ECB and the Bank of Japan are both, buying bonds to the extent of $60 to $65 billion a month. That's over $1 trillion a year. Where does that money go? Yes, it goes into the bond market, but then it flows out into risk markets because bonds that they're buying are close to zero or negative interest rates. And so it's an artificial game to the extent that central banks at some point, in my opinion, certainly, have to stop buying bonds and renormalize the economy.
So let me just ask you, though, how that gets you to real concern. And perhaps I'm saying real concern. You should define the concern for me. Are you worried? How worried are you about current valuations in the equity markets and frankly, the fixed income market as well?
Well, I'm worried that they're toppy and plateauing as opposed to about to sink. We're not headed, in my opinion, for a black swan event like Lehman, but, to
so
this
no
point going
systemic
forward,
issue in your view, and apologies for interrupting, but I just want to clarify that. Is there a systemic problem right now?
Not a systemic finance-based problem. There are secular considerations of aging demographics, boomers aging that have less demand for goods and services. There are problems with relatively high debt levels on a global basis, but no systemic problem that I see at the moment, unless we have some type of financial catastrophe. And the chances of that, I mean, I only ask that because, Bill, you and I have known each other a long time, and I feel like you can sense it, right? You can just feel it in the marketplace before there's a real systemic problem. And there's a difference, obviously, between the systemic problem a la 2008 and Lehman Brothers and perhaps just a run-up in valuations similar to what we saw with, NASDAQ in 2000. So when you look at the world that we now live in, would you tell investors be cautious because you're worried about something like 2000, that, things just get too high and people say, okay, enough? No, I'd say be cautious because the expectations of what we've seen over the past 12 months, or certainly since Trump was elected, probably are not going to continue. And so if you're expecting double-digit types of returns or even 6, 7, or 8% types of returns, I think prices are at a level where we're more apt to see 3 to 4% type of returns. So lower expectations and perhaps save
and what's
more
the reason for
if
that?
You, in fact, need money.
Is that because are you hesitant as to whether or not tax reform is going to get through, whether repeal and replace is going to happen, et cetera?
Well, I think that's part of it. I think in addition, money, credit, is flowing basically into financial markets. Money is making money. As we've seen in the past 10, 20, 30, capitalism itself depends upon money flowing into the real economy. And I think, for a number of years now, money has simply bought stocks as opposed to bought investment in the real economy. And so we have a 2% growth rate as opposed to a 3 or a 4.
Bill, how does that change? I mean, if the Fed can't do anything else, right, and other central banks are just effectively propping things up artificially, in your view, how do we actually start to generate some real growth so we can justify valuations such as we see?
Well, to a certain extent, monetary policy has helped. We're looking at fiscal policy in terms of tax cuts and deregulation. I wonder how much that will boost real economic growth. I think investors basically, and politicians and citizens on a global basis, have to get used to the fact that productivity, which is the essence of growth and the essence of real earnings growth, basically is much lower than what it was, and will continue to be, simply because secular forces are keeping a lid on our ability to grow despite fiscal and monetary policies that are very stimulative.
These secular forces, but I mean, is it sort of a systemic shift as well? In other words, our economy is changing so drastically, so quickly. Technology is playing such a bigger role, frankly, displacing a lot of people in terms of their jobs. We also live in a global economy, right, Bill, where a lot of manufacturing has shifted overseas, and it's like the genie's out of the bottle. I mean, how do you stop it at this point? These are the changes that we all need to confront and sort of get used to?
Yeah, I think they are, Trish, and they're not happening quickly, but they're happening gradually so that many investors can't really notice them. I'm talking about demographics where the world is basically aging. I'm talking about, yes, regulatory policies that have gone perhaps too far. I'm talking about situations in technology that you mentioned where robots are displacing people, and those are hard forces to stop. And I think I see them continuing, and I see real economic growth, therefore, lower than what it was in the past.
It's scary when you think about that. I mean, for all our kids' future, we want them to have the best opportunity in the world, and yet there's all these things happening that really suggest a kind of stagnant environment. But back to your initial point, I mean, tax policy, things that we can do out of Washington, hopefully, to less regulation, to try and generate things that might actually make the difference. Bill, before I let you go, I always like to get a sense from you on where you think yields are heading, and we've got the Fed, of course, tomorrow. Do you anticipate that they're going to continue on this interest rate rising path, and if so, what does it mean for Treasuries?
Yes, I think tomorrow 25 basis points, but I would wonder after that, that means the balance of 2017, perhaps not, and maybe 25 basis points in 2018. That's what the market expects. They basically expect not only the U.S. Fed, but other central banks to just raise interest rates by very small increments. And so, yes, that keeps a lid basically on volatility, that facilitates stock prices, but back to my original theme, I think we simply plateaued and we move up gradually as opposed to move up significantly.
All right. Well, gradual might be better for the markets to digest it than gradually. Bill, thank you, sir. Always a pleasure to see you.
Thank you, Trish.